Welcome, everyone. I'm Mike Bouchillon.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast. I'm your host, Mike Bouchillon.
And I'm Ashley Ward.
Today, we have a special guest joining us from Savannah, Georgia. She's the managing partner and co-founder of Southview Wealth Advisors, a prominent figure in wealth management and a dedicated community leader. Please welcome Melissa. Do I pronounce it Bouchillon?
Melissa Bouchillon, yes. And it's nice to be here. Thanks for having me.
Thanks for joining.
Well, Melissa, it's a pleasure to have you on the show today. We're excited to learn more about you and Southview. So let's start by diving into your journey as a financial professional. Can you share with us and our listeners the story behind co-founding Southview Wealth Advisors and what inspired you to create this independent boutique client-focused firm?
Yeah, so I have been in the industry for 20 years and I have three other partners and they have decades and decades of experience as well. And we started our journey at Merrill Lynch, which was really a great place to get started and did nurture sort of the entrepreneurial spirit that we all had. And for a long time, that was a great way to sort of deliver services to our clients. But we realized just over time that we wanted to be able to control options for our clients, control the culture more, and really rather than being in an institution where we kind of felt like we were fiduciaries and acting as fiduciaries in a larger organization that we didn't really have control over, we said, let's get out there, create our own firm, and create a place that really can be customized to what our clients' needs are. And so in 2016, we started throwing around the idea. By 2017, we were committed. And in 2018, March of 2018, we started Southview Wealth Advisors here on Skidaway Island.
Oh, wow. So you guys had just started there in 2018?
We did. So we did. Yes. So I've been in the industry since 2004, but we have been at it now for 6 years. When we started, we knew that we would be in a situation where we'd have to kind of shrink to grow. And so we had about $1 billion in assets under management when we were at Merrill Lynch. And we knew that we wanted the clients to come with us that really believed in our vision and really understood and were excited about what we were doing. And so when we moved over, we had about $750 million in assets under management. And today we have right at $1.9 billion.
Wow. So you guys were with Merrill. And pardon me, I always take notes and being at Merrill Lynch, right? Was there any non-compete with you guys bringing over the clients? Was there any non-compete with you guys bringing over the clients there?
So no, there was no non-compete. We were under broker protocol. So I always sort of have worn two hats since I've been in the industry. I ran training programs and managed several offices as the resident director. And so when we left, we just had to resign and provide a list of the clients that we were going to call and ask to come with us. And as long as we sort of did it that way and by the books, then it all went very smoothly.
Well, so let me ask you this. Were they heavy pinging the clients, to try and, build a moat around the clients leaving Merrill to go with you guys?
Absolutely. Right. And that's free enterprise and they should, right. They wanted to make sure that they were able to communicate their value add to having the clients stay and remain at Merrill Lynch. And fortunately, and you both know this and probably hear this all the time, that really clients and advisors, that's where the relationship lies. And it's making sure that you have platforms designed to help address a client's needs. And the more open architecture and the more you can customize to what a client wants and needs, the better. And so for a really long time, Merrill Lynch was sort of the best conduit for our services. But then over time, especially as we got further and further into that whole fiduciary discussion, we really wanted to be on the side where there was no question as to what we were doing, which was, knowing and understanding our clients' goals and objectives and being in a position to provide them good objective advice. And so the registered investment advisory model just resonated more with all of us and was a better way for us to sort of help our clients. And so we have been at it now 6 years. It's been incredible. And like I said, Merrill Lynch was a great place to start. And It was a wonderful 14 years there, but I love being at Soundview and being able to control the culture, take care of the clients that work with us and the people that also help us support our clients.
And you know what you're saying, resonates with me and makes a lot of sense because I followed my financial advisor, from a wirehouse to a small RIA and then to when, she and a couple partners went and opened up their own thing. And I don't even like them. Right. So, no, joking aside, I no, I can tell you as it stands now, that I've been, now that I've been passed off, right, to one of their, this advisor there that, where, and look, I'm no huge fish, right? I remember, what did they have? They started off with $30 million, right?
Mhm.
From leaving, from what they took from the wirehouse. I believe, yes, it was City Private Group from City. Um, and then they went to a small RIA, and then from that RIA, they maybe started with 100 million from there, and they're at 6 billion. They're at $6 billion now, right? That they've built that in a
Mhm.
10-year time period, right?
That's
So I've been,
incredible.
I've been passed down, but the CEO is still a really good friend of mine, and I more give him crap than anything else at the these days. But actually, both of them are good friends of mine. But what I wanted to ask you there is, how many other partners besides you left Merrill to found Soundview?
There were four of us total.
And as it stands now, how many total advisors and how many total teammates do you guys have?
So we have 17 of us that are now part of the firm. And so there are six of us serving in an advisory capacity. And then we have a variety of client managers, operations. I mean, it's financial planning. We are very much a planning based firm. And so we've really spent a lot of time and energy in building out a platform that we felt like could accomplish what we needed for all of our clients, right? And our clients are mostly families and individuals, and they range from, the grandkids to, managing larger families in sort of a small family office type of way. So we really wanted to be that boutique firm that could help people as they grow and as their families grow and evolve and change and be just there for them. And so that was one of the most exciting parts of founding your own firm is you could build out the platform. You could have a true open architecture platform where we don't just, have our clients' assets custodied at Schwab. We also have Fidelity as an option. We have a variety of different tools that we can use. And when we want to make changes and update our planning tools, update our estate planning tools, whatever it is, we're able to do that in a much faster way than you could accomplish if we were just kind of going, hey, when we thought about change at a larger organization, takes a lot of time. And within a smaller organization, you can be a lot more nimble.
And let me ask you this: have you guys done more organic growth or inorganic growth, or a blend of both?
100% organic growth. So we have
Wow,
not hired any advisors or merged with anybody. We've just, we're big believers in you work hard, you do what's best for your clients, and good things happen.
really cool. Thank you.
And so I'm curious, Melissa, considering you and your team's background and experience at Merrill Lynch, was there any specific challenges that you and your partners faced when transitioning to, independence and running your own firm?
So I would say yes and no, right? There's always the unexpected pieces that you just don't know. Even with my experience running offices, I hadn't ran a registered investment advisory firm before, and so there are just you're creating everything literally from the ground up, from the compliance manual to the platform to the interfaces for clients to all the processes. So that was, a challenge, but also an opportunity to really take what we liked and we thought was working, but then also build upon it to make it a better, more efficient platform. We really wanted to be a company and an organization that was client centered, client focused, and easy to do business with, easy to work with. Because that's so critical. We also felt like with technology, it's great because you can do things faster, but it also sometimes can separate people because you don't get to sit down face to face or you don't get to talk and hear their voice. You're texting or there's emails. So we always want to be an organization where people can be served by people and human beings are being served by humans. And so in just having the ability to make sure that clients can get to us, they have access to us, is kind of mission critical. So we built the organization in a way where we're always there, and we don't want our clients to feel like they ever get kind of passed off because we grow so much and then they're working with someone else. Everybody's important, and whatever success we've had, it's because of the faith that our clients have put in us. And so we're just super appreciative to be where we are. When we did make the transition out, we did enlist the help of Focus Financial Partners, which was a private equity firm at the time. They went public and now they're back private. But the whole concept there was, one, we wanted to make sure we were covered from a basis standpoint. We knew what we knew, but you don't always know what you don't know. And so having them as a partner to help with the transition was tremendous. And then as we kind of sit here today, one of the nice things is that we are being tied to a larger organization with so many other investment advisory firms. We have peers that we can lean into, talk to all around the country and say, hey, what are you doing about, what are your thoughts on the market? What do you think is going to happen with interest rates? How are you addressing this estate planning need? And I think that's really important, having people to collaborate with outside of your just smaller office, right? So you get perspective. And so yeah, so it's worked out great, that partnership. I like to say we took what was best about being in a larger organization, merged it with being a registered investment advisory firm where we had the autonomy to create a really customized platform to help our clients, but we still have the benefits of larger resources behind us from a research perspective. When we're talking about Schwab and Fidelity, we're Fidelity and Schwab's largest client, being part of Focus Financial. So it's been a great move, and we've never looked back.
Oh, wow. So let me ask you guys this. Did you guys partner with Focus out of the floodgates?
So yes, so what happens is initially they helped us move and kind of make the transition, and then after a year, assuming we're successful and the partnership made sense, then that's when the agreement was formalized. So technically, we kind of formalized our agreement with Focus in 2019.
So let me ask you this, if you don't mind me asking: Is Focus are you guys, are they like a minority partner in you guys, or are you guys like a wholly owned subsidiary of them? And
Yeah, great question. They have an interest, and they have an ownership interest in us. We own 51%, they own 49%.
oh, that's great. Good for you guys. Yeah. So let me ask you this: when you take a look at what the future of Soundview, which, by the way, I got to tell you, this industry, as we know, is, I'm not going to be an ageist here, but the average age of the advisor in this industry is almost 60, and some of these names that we come across are like, I don't understand where I don't understand where that came from, right? Soundview, I think, what a great name, by the way. What made you guys come up with it?
So when we were trying to start the firm, one of our big questions was, okay, we know what we want the look and feel to be, but what are we going to name this thing? So I had all the partners kind of brainstorm a list of names, and it was everything from wealth and Latin to just a variety of names that we thought were all super creative, and come to find out they were all taken, right? So
Yep.
I was driving home late one night, and as I was driving home and kind of frustrated because I'm thinking, if we can't even name our firm, how are we going to ever pull this off, right? I can't even name the company, never mind start the company. And so I just started to play the name game, and every street I drove by, I would add wealth advisors to it. So we had Monastery
That's
Wealth
cool.
Advisors, and I'm like, that doesn't sound so good. Tapestry Wealth Advisors, because I passed Tapestry Lane. And finally, I was running out of options because I was making the turn onto my street, and there's a small little cul-de-sac called Soundview Lane. And so I said, Soundview Wealth Advisors. Kind of like that. It has a nice ring to it. So the next day I presented it to the partners. We ran it by our marketing department and our marketing folks, and they loved it. And so from there, it was just, it's been a great name, because what we do is we provide sound advice to clients. And if you think about it, when we were developing the company, we did it from our house, which is on the Wausau Sound. So it has lots of different meanings, but thank you for saying you like it. I love it too.
Oh, look, I got to personally tell you that, every company I've ever had, I can't tell you one company that I've ever owned that I like the name of, right? Um, you know, but before we were Rise, I did like the name of our company then. But we got a cease and desist
Mhm.
from, and it was it was just that. But yeah, when thinking of, and listen, I'll tell you this, my last two companies were both a huge success. So I'll never sit, I will never sit there and say that, it's the name of the company that makes the company, right? It's always the company that makes the company. And, it's the people, right? Without a great team, the company's going to be nothing. It doesn't even matter how much money and how much financial backing the company has. If your team is not good, then your organization's not going to be good. So what I was going to ask there, and what do you see as the future 5 years down the road? Where do you guys see yourselves? Do you guys see yourselves branching outside of the organic growth strategy, or do you guys see yourselves where do you guys see yourselves growing to with employees, AUM, any special projects on the horizon that you guys are going to launch?
Yeah, so those are all really good questions and things that are on my mind constantly. I think really the goal is always to make sure that we're a platform, an institution, organization that puts clients first. And so since we've been in existence, we started as just one office and now we're three. So
Real
we've
cool.
expanded to the Statesboro area and also to Bluffton. And we tend to build offices in areas where we have clients, right? So we want to meet people where they are. So that's kind of, that strategy I think will continue
Well,
over
can I
time.
ask you this?
Yes.
The Bluffton and the other area that you said, I don't know Georgia very well, but is that where all the what would you call it? Is that where all the people with the shekels lie? Right? Is that where all the people?
So Statesboro actually was interesting. We opened the office in Statesboro back in, I guess it was 2021. And we had hired someone who was a phenomenal trust officer. And she was living in Statesboro. She had several clients in Statesboro. And then just too, from a strategic standpoint, we needed more space. And with being along the coast, to have a spot that wasn't directly on the coast made a lot of sense. Soundview Wealth Advisors is on Skidaway Island. And so to have an alternative just in case of an issue from a hurricane perspective made a lot of sense. And we also had clients already there. With Bluffton is one of the fastest growing zip codes in South Carolina. So again, it made sense to have an office there. And they're really underserved in the way of registered investment advisory firms. And so being able to bring what we do and how we help with our clients, I think was important for the area. And it's been extremely well received. And the chamber and the folks in Bluffton have been great partners to us.
Well, thank you for sharing. And let me ask you this: where do you guys, pertaining to my other questions, where do you guys see yourselves as far as size of the organization?
Yeah, so I always want to grow responsibly. I think it's easy to sit back and say, okay, you know what? We just want to merge, get bigger, combine firms, and oh look, it's so wonderful. We have $10 billion in assets under management, but the culture isn't there. You spend so much time and energy trying to merge cultures or partners or perspectives that aren't really aligned. And so over time, as we kind of look to the future and as we've even talked to others, we really want to make sure that we can preserve what we have from a cultural perspective because it's mission critical. Soundview Wealth Advisors is a great place for clients to come where they know they'll be taken care of for generations and we will always do what's best for them. But it's also a great place to work. And I don't ever want to lose that. We've got an organization where we have flexibility, we have the ability to grow. Every person can really view this as they see their purpose in their work, they're doing their best work, and they get how they're contributing to making a difference in someone's life. And that's not everybody's take and twist on an investment advisory firm. And I think if you go to our website and you see it resonates, right? If you hear the other partners speak, you just recognize there are two things we're most concerned about. One are the people that we're serving, and two, the people that work with us to help serve our clients. I think if we continue to get those two things right, our assets under management have grown and will grow responsibly, and we'll continue to put offices in places where we're needed.
You know what? I like what you're saying there because being in this in this space. We're in the private equity space for making minority stake acquisitions and RIAs. In case you didn't know, this isn't how Ashley and I make make a living. But needless to say, I could tell you that there's been companies that we've talked to. I mean, haven't had hundreds of conversations at this point, right? That where there's a majority owner that has a couple billion, and then he'll bolt on 500 to a billion of a couple more companies, right? And we'll have our conversations with them, and gosh, I mean, if you are a fly on the wall there, these minority stake. It was more the minority stake individuals that were like, yeah, if I had to do this all over again, I would have never became a part of this company, because they're so, where it was at the point where, with them maybe having, 500 million and becoming part of a $3 billion firm, and then having ownership and less ownership, but in a $3 billion firm, which means the multiple gets driven up there. Right. But they said, my clients are not first anymore. My employees don't seem like they're first anymore. We feel like it's more damage control than anything else. And and listen, I will say that there's been great. There's been great stories as well. But there's also been some war stories there where as you said, the culture and the client's experience gets watered down, right? But the company continues to grow, right? And I guess if some people are looking for an exit and they're okay with good but not great, then that's okay. But I think that ultimately there are a lot of people in this industry that they want to maintain a level of great and don't really care about becoming the biggest fish on the block, right?
Yeah.
So
I think there's a large degree of mediocrity,
yeah.
right? And so I think and people get excited about size, and really what I get excited about is how can we build a platform that feels institutional in access to investment options and alternatives. We have some great minds working with us, but again, we never get away from our focus and our primary purpose, which is serving our clients. And I think if we continue to use that as sort of our compass, everything else happens.
Thank you.
Right. And, Melissa, let me ask you this. Looking ahead, what do you see as the future of the industry? The future of wealth management. There's a lot going on, a lot of new technologies. In terms of innovation technology, what do you see as the future of the industry?
Yeah, I think, the big question is sort of where does AI kind of come into this, and how is this going to impact our industry and so many other industries? And I think there's, obviously still a lot of unknowns, right? It's like going back to before we had the internet. If you think about, how you used to do research, right? You'd grab the journals, you'd be on the little computer or the little system with the microfiche. And the world changed so dramatically with access to information, and so much information at our fingertips with the internet. We're kind of at the forefront of that with AI and the technology that's being created, and how we're going to use that more effectively and efficiently. I think within our firm is all going to be about using those tools to drive our ability to interact with people more and better, right? And so there are things that machines do better that people don't have to do. But when it comes to analysis of a client's needs, when it comes to taking the behavioral aspect of what we do and combining it with what we know they need to do from an investment strategy standpoint and an estate planning standpoint, a machine can't factor in all those emotions. And that's where I think we're going to be able to make the greatest connection. So more and more, I think it's going to free us up to just be with people, helping them solve their problems, and then have greater resources behind us that'll drive more efficiency to really allow for that human interaction to improve.
Yeah, I agree. Thank you. When I think when it comes to when it comes to I would say alternative investments, right? Sectors outside of AI, right? Because AI that's became such a redundant question on some of our podcasts, and so what do you like outside of there? Do you like I mean, I'll go in another question after that about commercial real estate and whatnot. But what investment sectors do you like outside of artificial intelligence right now?
Yeah, so as far as artificial intelligence, I wasn't really even speaking of that as an investment option. I was talking more about how I think it's going to drive our industry and really allow people to, we think of it as going to be taking us away and becoming
Yeah.
more mechanized. And I really think it's going to drive the human factor more and make the human factor more and more valuable. And it's going to enhance the conversations we have, hopefully. From an investment strategy standpoint, we really focus on, for our clients, yeah, like a lot of things, right? And depending on what a client needs, what they have, their asset level, their cash flow needs, their estate planning needs, their age, their goals, their time horizon, those factors, really gaining an understanding of where someone is and what they need, then we back into what strategies are most appropriate. And so, private equity, as an example you've mentioned, a very interesting space. Is it something that's appropriate for all? Absolutely not. Private commercial real estate has been under great, a shift over the course of really kind of since the B REIT went under a lot of pressure in November of 2022, right? Just from a
Right.
perspective of, okay, there were a lot of liquidations. They were not able to meet those. And so there was the discussion of how liquid is some of this private real estate. We like the private real estate space when and where appropriate. And so I don't think we can pick out, and that's really not our approach to kind of make huge sector calls. We really believe in building portfolios that are customized and diversified to meet our clients' needs. And there are a lot of factors that go into what areas we would overweight and underweight.
I'm glad you said that because I was really heavy weighted on the Nasdaq, right?
Mhm.
In 20 in well, no, when was it? That was the Nasdaq and the IWM in 2020, from 2020 all the way up until now, right? And I got crushed so bad in 2022, right? And obviously, I didn't, I didn't I didn't cash any positions in, maybe a couple, but you know, I've had to wait it out, right? And finally my portfolio is something where I don't cover the top number up when I open it up anymore because it would just make me it would make me so sick to my stomach when I looked at it, right? But finally it's something it has rebounded to a point where I don't have to cover the number. And I said to my advisor the other day, I was like, you know what? I know you're gonna hate me for this, but I want to de-risk right now. At least half my portfolio. And he said, hey, listen, why don't we start off with a third? And if you still feel this way in 30 days or 60 days, then we could do another 25% or a third from there. And so and that's the way that's for me. I've realized that the best things that I've ever invested in that I've made money from, for me is that investing in myself, my own business, and real estate, right? And I personally don't have a strong appetite for the stock market, and if there's certain fixed income assets that you can get 5% on right now, to me, hey, you know what? I'm perfectly okay with that. I've gotten to realize because if there was a risk tolerance, and ultimately in being in business for myself my whole life, if I know that that's where I'm willing to take risk. But if I'm heavily weighted in the market that I don't have control of, right, then that's taking on too much risk for me. So is that how when do you have other clients like me, or do I sound like a enigma or anomaly from there?
No, I think you're exactly what you explained is sort of, if people are left to their own devices, they either tend to take too little risk or too much risk. And really,
Mm-hmm.
the key to driving a portfolio sustainability from a standpoint of people being able to stay invested is the key. Over
Yeah.
time, in the stock market, in the bond market, being an investor, you will earn money and grow over time. But what happens is we follow, right, this herd mentality of, okay, let's put it all in here and let's try to drive these outsized returns. When really, if we apply a disciplined process and align our investments with our liquidity needs, with our risk tolerance, with really kind of where the markets are, there's all different factors that come into play. And then obviously transition then transition that and tweak that as needed. The goal is really to help people stay invested, not in a rush to get invested, but be in a strategy where they're going to be able to have longevity. And if they can have longevity over time, they're going to do just fine. And what we're focused on is driving positive outcomes for our clients. So whether they can do that with real estate, whether they do that in the stock market, whether they do that in their own business, it's helping them drive those positive outcomes is really our goal. And the key is, and where we see people make a lot of mistakes, is they don't take into account all those factors. They get caught up in kind of listening to the hot stock of the day, the sector of the day, and that is not our approach by any stretch of the imagination. And so and for our retired clients and our clients that are no longer working and have spent their lifetime saving, earning, sold a business, whatever it is, they now have to live off of the assets they have. And so we have to make sure that we have a portfolio, and we create a portfolio of indifference that allows them to weather through good times and bad. When anybody hires us, we tell them, hey, listen, one thing for sure, when we're working together, we're going to go up together and we're going to go down together. We're just not
Right.
sure what you order, right? But over time, there's volatility in the market. So getting people to expect it, understand it, know the risks that they're taking, but also know that there's a plan, that when things are bad, like in 2022, when the S&P 500 is down 18% and the bond market's down 12 to 15%, that's scary if you're not living off your portfolio. The NASDAQ was down even more, right? You're covering that number, but it's especially frightening if you're living off your portfolio, you're retired. And so you just have to always manage where someone is, their risks, and make sure that regardless of what happens in the market, they're going to be able to reach their goals. And so we structure portfolios in a way to make sure that whatever they have that has a component of illiquidity or a level of market risk, that we have enough assets that are liquid and income producing to balance that out, so they're never forced to sell when the market isn't ideal for whatever asset class or whatever sector.
Yeah, I mean, what's crazy. I really resonate and like what you said there, and I think what's crazy is that 2022 was one of those years that was a total anomaly, where you not only had the stock market you know going down in big numbers, nothing like 2008, of course, right? That was,
Right.
and I think that's what people really think about that. They go, oh my God, if the market's going down, it's another 2008 again, right? Or I mean, we saw a pretty big dip when COVID hit, but if you take 2008, 2009, right, the time before that happened was only one other time, right? COVID was a total anomaly, but it's not like every time that the market goes down, it's going to see those it's going to see those type of numbers, right? Is going to see 2022 was, as you said, 18%. But also in 2022 there was people that put money into stocks that were they put money into stocks before. Like, I had a buddy who his company went public. We all had money in the company. Bought it at 60 cents a share, went to $11 a share. I remember de-risking half my portfolio. I remember another buddy turned, I think, maybe, gosh, 100,000 into 11 million, right, with investing in his company. And I remember telling the guy, hey, you should cash in at least half of that, man. I mean, you turned 100 grand into 11 million bucks, right? Like, I mean, and he's like, well, so and so said it's going to here. And I was like, what? Listen, like, and he didn't. And that stock has lost 99 plus percent of its value now, right? Like, it legitimately 99 plus percent of its value. It's below a penny stock. And so,
So that
yeah,
level of risk is exactly what we're talking about. And a lot of our clients that we work with have amassed their wealth over a lifetime. And so they don't need to have outsized returns or take
yeah,
significant risks. They really want to make sure that if we can drive good, consistent returns over time, they're going to be more than just fine. And we do it in a way that's defined and repeatable. And to your point, you can never expect what's going to happen throughout the course of history. The market has gone up and down significantly, double-digit swings. And you don't know, nobody anticipated COVID, right? People didn't think back in 2008. I remember being in my CFP classes, and there were a bunch of mortgage brokers in the classes with me
oh,
studying customer-side financial planning designation, and they would sit there and tell me how, oh my goodness, I've got clients, it's wonderful. They just have to tell me their income and they can buy a house with zero down. Now, I didn't know that 2008 was going to occur, but I knew something was wrong, that couldn't last forever, right? It was too good to be true. Didn't make sense. And so I just think, and same thing with COVID. Nobody could have anticipated that COVID was going to occur and the impact it would have. But you just have to have a portfolio where you're nimble. And we spend a lot of time building out a plan for our clients. We spend a lot of time focused on the strategies we're utilizing and making sure that they're doing what we expect. And then we also spend a lot of time on education and managing, not just kind of, hey, here's the right investment strategy, but making sure clients have a good understanding so that they make good decisions. We try to help people drive good decision making. And if we can do that and help them solve their problems, then I think we're going to have a job regardless of what happens in this world and in this industry, right? Whether people roll up into one big firm or whether everybody decides to go independent. I think if you have to differentiate yourself in this industry. And, unfortunately, we're in a world where if you do what's right for people, you focus on the client and you deliver good, honest, objective advice, that's not the norm. And so if we're exceptional, if we can do that and if we can deliver that consistency consistently over time, and that's really our goal. And so we want to attract clients who value that. And we want to attract people to work with our firm that have that same drive, have that same mission.
And so, highlighting on that, you were talking about knowing that something wasn't right. In my former life before private equity, when I told you that I've had um, uh, my twin brother and I, we've had, two sales of two different companies. We were in the mortgage. World, right? The first company was a retail company where we were direct to consumer, and the second one was a mortgage bank. We were a mortgage-backed security aggregator. That's how I know Ashley actually was. We've been working, at my previous company. I had hired her, so we've been together now for about 7 years. But being in the mortgage world, right? How much the pendulum swung from, gosh, I mean, even 2020 until now, where interest rates have been. And when I got in the industry, it was 1993, 94, I believe. And I got out of the industry in 2020, right? Went from, rates being at 9.5%, 10% down to 2. And then after that, you're like, well, if getting back into the industry was, well, I couldn't because of a non-compete, but also I thought, after a run like that, you don't really, you don't really want to get back in the industry. But I can tell you that when that individual was talking to you about that 2008 and knowing that something was wrong there, right? I think that one of the only reasons why my brother and I were able to stay in business is because we didn't partake in those loans, right? And it was hard because we were called. They called us the squares. We were called the squares because we didn't do those stated income loans and whatnot. And we ultimately took risk, but we didn't have to sit there and buy back a bunch of defaulted loans when the market, went to hell in a handbasket, right? Now, leading into, sorry to pontificate in that direction, but it leads me to my, final question with you here. What's your economic outlook? Do you see anything? We've taken on so much debt. Interest rates obviously have gone up. The market seems to be doing pretty resilient towards with where the interest rates are. I know in the mortgage industry, it usually happened where if the 10-year Treasury went up, the stock markets went, and that's the 10-year Treasury that controlled the mortgage interest rates, but the stock market would even out or go down. It seems like both of them are both markets continue to rise at this point or stabilize. I know it's an election year, but what's your economic outlook? What do you think?
Yeah, I think that's a great question. I think there's a lot of unknowns and a lot of big factors, which is not unlike other times in history, right? I think if you look back in 2023 and kind of where we started the year, people were fearful of inflation. They were fearful of interest rates going up. If we look at second quarter, we had banks failing, right? If you think about that. Then we had the summer and we had war in Ukraine and everything that's happening in Gaza and the war with Israel and the attacks in October. Then you had the Fed come out and say, hey, guess what? everything's going to be okay because I think inflation is under control and we're going to be able to start lowering interest rates rather than having to continue to raise them. And so what happened to the market? The market was off to the races, right? And one of the transitions we've seen last year, it was really driven, and we've all talked about this, the Magnificent Seven kind of drove the majority of the market and the return. This year, it's been more broad based, but it's been volatile. We've seen, April, the market pulled back some, interest rates went up again. So it's just going to likely be kind of in that volatile space where we've got a lot to digest. And will the Fed be able to unwind this perfectly? I mean, we have been really kind of flooding the economy from a standpoint of just, the amount of capital and easy money that existed for so long is not something that's easily unwound. And we can see that, inflation is not completely under control, right? It's higher than we would like. And so interest rates are probably likely to stay higher, but that's
Oh
not
yeah.
necessarily a bad thing. When you think about it from an investor's side, we now have, and you mentioned this earlier, the safe rate of return at 5%. People are earning money on their cash. It's been a long time. Back in 2004, I could ladder high quality tax free municipal bonds that were yielding 5% tax free. But we spent, a couple decades in an extremely low interest rate environment, which pushed individuals to have to invest in the stock market and take risk because they couldn't put $2 million in a tax free bond portfolio. What once earned $100,000 tax free was down to about 50,000. So people had to shift their strategies. And so I think in this environment for retirees, having a component of assets and fixed income that's earning something is a positive. I do think that it'll be interesting to go watch and see sort of where interest rates go and how things are impacted. I don't know that we're going to see an interest rate decrease before year end. And then we've got a huge political unknown, right? And what the market likes is certainty. And so if there is a certain outcome for the election, that would likely be beneficial. But how likely is it that the election won't be contested? I think, regardless of which party you're pulling for, a contested election is a possibility, which will create near-term volatility. The debt issue is a big issue, and that's something like longer term, we're going to have to address it, right? Just like the mortgage situation didn't make sense. That can't go on and exist forever. But will those issues kind of implode in the next couple of years? Probably not, right? So,
Well, let me ask you
and
this
then,
though. Do you
and
think
then
that the debt was taken out? Do you think that the debt was taken out at a lower interest rate? Does that, I mean, because of that, would that help that situation out at all? And I'm asking, by the way, I'm being
right.
inquisitive. I really don't know.
So the debt, the government debt and government bonds, as interest rates go higher, the
Gotcha.
U.S. government's debt and the cost of financing that debt goes up, right? And so that's, an issue from an economic perspective. And then I think you've got a situation where people feel really good if you own real estate, right? If you own a house and if you have liquid assets, your net worth has gone up. But if you don't, you feel really compressed by higher prices. And when you go to the grocery store, we all notice that it's hard to get out of there without spending at least, 100 or hundreds of dollars if you're buying for a
Right.
family. And so that's a big change. And the average family, that's a constraint. And so if you look at debt levels, they've risen. And so I think it's really kind of, there's this tale of really two possibilities. Some people feel really good and others feel really constrained. And so there are a large group of people that drive the GDP and the growth in this country. And if they're struggling with credit card debt that's at 24%, and if they're struggling with higher prices, that will start to slow growth. Now, if we look at companies and we look at where they are and how earnings have been, they've been really positive.
Yeah.
And overall, the stock market has done well. So really in the near term, what I would say is, expect some volatility. And so you want to make sure as you're looking at your own individual situation that you have enough liquidity for what you may need in the next 12 to 18 months and that you're comfortable with the risks you're taking. And we've had tremendous gains. The market was up over 23% last year. The S&P 500 is up 12% this year. Make sure you're rebalancing your portfolio, that you're diversified, you're taking gains, and that you've got the liquidity you need not if the market goes down, but for when the market goes down. So there's lots of potential outcomes, and so I think you have to manage the factors that you know and understand. I always say control the controllables.
Yeah, and to your point there, um, when you talk about that, do you think so many homeowners took advantage of that really low interest rate, right? I mean, you have you know anybody that owned a home, right? And ultimately, having been in the industry, I know as well, even if your credit wasn't so good, you were still able to get 150 basis points higher than what that 2.5 or 2.75 what a lot of people were taking advantage of, right? So you have so many people that got locked in at low interest rates, became homeowners during that time. Ultimately, nobody's gonna be walking away from those. I mean, walking away from that low of an interest rate to go buy a new home, which is going to landlock a lot of people, and people growing their families, people taking jobs in other states and things like that. But in retrospect, with people being locked in at that low interest rate, do you think it creates that free cash flow that's been able to fuel the economy?
Well, I think that probably most people build their budgets around, okay, hey, what can I afford at the time? So I don't know that people have necessarily looked at that. I think it creates an affordability issue today, right? They're not able to say, okay, hey, I'm going to sell my starter home. I've got a 2.5, 3% interest rate and go buy a house that's larger. I think that's a
Yep.
real struggle for people. And the interest rate is going to be 6.75%. Not only are they increasing the size of their mortgage, but just with that interest rate increase, the payment becomes outsized. And so I think it's slowing that move for people to where they're looking and saying, hey, maybe I should look at the house I have and could I do some renovations to make this work? But I don't know that they had a tremendous amount of free cash flow when they initially entered it. Some people did, and some people don't, just depending on how they manage their balance sheet and their budgeting. It has impacted people that are just first time home buyers and getting in the market, right? In certain areas, everything is just incredibly expensive. And there are still bidding wars in some areas. New
Yeah.
Jersey,
Yeah.
Skidaway Island, there's not a lot of inventory. And so that's an issue. So you have people that desperately want to buy homes, even at these rates, and just are struggling to even find a home. So
Right.
it's an interesting environment. I think it's a tough environment to definitely kind of make that change that you were saying from a house that you're in with a low interest rate to kind of have a compelling reason to move and have a higher interest rate.
Right. No,
Yeah.
I appreciate your answer on that, because it's I think when it comes down to when it comes down to it, it's um you know I'm curious to see what these next 3 or 4 years are going to look like, and I know that there's caveats to the marketplace and whatnot, but I do think that there's I do think that there could be a level of I'm not going to call it a 2008 or 2009, but I often wonder if there could be maybe that little bit of a level that's going on there. So
Well, I think it's a different environment just from a standpoint of the banking and the lending practices of most of the larger institutions are a lot more prudent and rigorous than they were in 2008, 2009. So I think that's a difference. And then I think, the inflated pricing that we're seeing, it's really kind of a supply and demand issue to a certain extent in certain areas. And so we'll just have to see kind of what happens with new home building and just, if interest rates go down, makes, new home purchases more affordable. So I think it's kind of a watch and see. I don't know that we're in a position where we're going to see another 2008, 2009. It'll be different.
thank you.
We always fear we have that recency bias. We fear what we've been through,
Uh-huh.
but it's really kind of what's ahead is typically different. And so it's kind of being in a position to always anticipate. We don't know what the next big issue will be, right? We just have to make sure that we put clients in a position that we apply a disciplined process, that they're going to be able to have positive outcomes regardless of the environment.
Yeah.
Yep. Interesting times ahead for sure. Before we close out our conversation today, Melissa, what final piece of advice can you leave our listeners with, for any aspiring entrepreneurs, wealth managers, financial advisors looking to make their mark in the industry?
I would say to any advisor that's starting in the business, I think, really recognize the fact that what we can really do great work. And, my hope is that people realize that this isn't a position where you're selling people things. You really are helping people. If you think about somebody's health, their family, and then their finances, allow them to do all the things they want to do to help the people they love, to make an impact in society. And so I just hope people recognize that this job is critical, and the level of kind of good, objective, honest advice where we're trying to help people reach positive outcomes is mission critical. And I think too often it's approached as, hey, this is a sales organization, sales job, and you're going to sell, sell, sell. This is by no means how Soundview operates or how I think the industry should operate. I think people are in need of solid advisors. And if you do that, you will significantly differentiate yourself from the tens of thousands of advisors that really have the sales perspective and not the perspective of, hey, I want to help people because this matters, right? And we've all been taught sort of within our culture that you don't talk about money. It's like kind of taboo, right? We don't. And so being able to find that trusted advisor that you can lean into, that they're going to help educate you, they're going to help build sound strategies, they're going to help give you really good advice that's not in their best interest but in your best interest, that's mission critical. So if you can figure out a way to do that, you're going to have a really incredible career, and I think the success will follow.
Thank you.
Very well said. Well, Melissa, thank you so much for joining us today, sharing your wisdom and your insights with us and our audience. It's been an absolute pleasure having you on the show.
Well, thank you so much. I appreciate being on here. Thank you.
And to all of our listeners, thank you for tuning in to another exciting episode of the What Matters podcast. Remember, success is not just what you achieve, it's about the impact you make along the way. Until next time, stay curious and keep exploring. Thanks, everyone.